Volatility index topped out. Did it hit 30? It hit 2950. This is, of course, an indication of market volatility. And what we saw here was the VIX got really high really fast. And typically, the way I look at this is that when everybody gets scared, the risk premiums start to get attractive. Now, if you don't know what a put is something that you can buy in the options market. It's a bearish bet. Basically, you're saying you think something, whatever the underlying is, let's say it's the S&P 500, you think that the market's going to go down in the next, let's say, 1 week or 1 month or 1 year. You can buy puts for different time durations. Well, if everybody wants to buy puts, if everybody wants to bet that the market is going to go lower, which is what we have seen recently, everybody flocking to buy puts, what happens to the value of those puts? Well, naturally, supply and demand. If everybody wants to buy puts, the price of puts goes up. Now, not just puts, but also calls. If the market is expecting a big move, right? If the market is scared, they typically expect the market to move more. Well, the reason I'm bringing this up is because the market has been getting very scared here recently, and puts skyrocketed in value. That is until the last few days where they dropped back pretty aggressively. But my point with showing you this is that nothing is easy, right? So a lot of people, I've had just comment section guys has been crazy. The bears are back in 2025. People who are saying, oh no, the market's going to crash. This is the year. Maybe they're right. And eventually they will be right. It's just the problem is they've been saying it for 15 years straight. So here's the thing. When everybody wants to bet, this is why even shorting the market is not easy, right? Nothing is easy. Nothing in trading is easy, because even if it's so obvious, quote unquote, that the market is going to go lower, well, the problem is everybody buys puts and the value of those puts gets very expensive. Now, why does that matter? Well, it means that if you're betting that the market goes down, it has to go down a lot to pay back the cost that you put into buying those puts. Does that make sense? I hope it does. I know it's a little bit confusing for if you've never, really learned much about options. I understand that could be confusing. It's basically just saying that when everybody wants something or thinks something is going to happen in markets, the risk to reward gets really squeezed out of it. Lee says, asks a great question. Nick, at what point does a correction turn into a bear market? Great question. So on a technical basis, a correction is anything before 20% down. So right now we are in correction territory. 10% is a correction. So we've bounced back a little bit here. 20% is considered by most standards to be a bear market. So are we in a bear market? No. And I've been very adamant about recently saying that I think this is your garden variety pullback. I think most people on the internet you listen to, a lot of them are going to say, they're going to feed you the bear PO, in. Okay. That's what's selling very well is people who are, the news medias, right? They're all telling you it's the end of the world, right? That is what is selling right now. You have the choice to be a buyer if you want to, go for it. But in my opinion, I don't think that, tariff negotiations are going to lead to a massive market crash like the likes of 2008, right? That's what it seems like the market's trying to tell you, or not the market, the news media is trying to tell you. Well, I've looked into some stuff over the weekend, and I thought it was really interesting that amidst all the negative headlines and fear that is being sold to the market, institutional money bought the heck out of the S&P and the Dow. Isn't that interesting?
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
Headline media. It's crashing. Trump's going to blow the market up. It's the end of the world. It's the end of days. Institutional money buys the dip. Really? Come on. It's just crazy how much they can just manipulate. Anyways, the news media, they're just doing what gets clicks. Look, I'm guilty of it too. My videos where I put something on the title, oh my gosh, the market's freaking out, get way more clicks. I'm not gonna lie, I do that too, because it gets people to watch my work. If I don't do that, I get half the views. And why does that matter? Well, number one, I'm running a business, but number two, I genuinely believe that the content that I'm putting out, maybe this is hubris, but I think that it can benefit people. What I share, I believe I'm giving my all to the trading community to share what I have learned and what has helped me in the trading, my trading career. So I want more people to see my message, so I kind of have to do it too, right? But everybody does that, right? That's the point. Is there's just so much fear. What I'm saying is dial it back, right? Don't freak out and just understand that what we want to focus on is the data. And I want to show you some other data that's really important. The put to call ratio. I know I'm a broken record recently. If you've been watching my streams and videos, you know I oftentimes repeat myself, but it's on purpose. Somebody said, Nick, you need to just do one video a week because you just say the same things. And I said, that's a pretty good roast, not gonna lie. But I would disagree strongly, because I actually think that reinforcing this stuff every day, whether it's you as a listener of these videos, whether you agree with me or disagree with me, let's have this forum. Let's do it every single day, because it really bakes in the point, right? We want to really nail in the reasoning behind what we're doing as traders or investors. So I look at this and I say, look, put to call ratio, still very extreme. People are out there buying the fear, right? One of the best salesmen out there. I appreciate that. Genuinely, I do have a passion for sales and marketing, as if you know, clearly know on the stream. I talk about that all the time. I always have something for sale, but I always also mention that what I sell, I personally believe in myself. Always. It's a principle. Nothing wrong with being a salesperson, but I believe that if you're going to sell something, you should sell something that you personally would buy and believe it's worth the money. How to use the smart money indicator? Yeah, let's look at it. So the smart money indicator on the Edge Finder is pretty cool, because what it does is it basically loads in the institutional positioning versus retail positioning for key assets and charts. So let's just see, for example, let's do S&P, because I'm on an indices kick recently. So institutional money is buying, and retail is very, very bearish, right? So the way I'd look at that is when we see convergence, that's not as interesting. But when you see divergence between what the crowd is doing versus what institutional money is doing, I find that to be a really useful indicator. But personally, I know that the smart money indicator is popular because you can look at both at once, but I personally like to look at them in isolation. So I'll look at first the put to call ratio, which I believe is one of the better ways to gauge the crowd sentiment. So right now, and by the way, we have put to call ratio for gold as well, right? We know there's a lot of gold traders. A lot of gold traders are very scared, actually, buying puts. Interesting. High demand for puts here on gold recently. So if we go to S&P, right, there's a lot of people out there who are fearful about the S&P 500, and they're paying premiums that are very high for S&P 500. And the reason I point that out is retail getting really loaded up on bearish bets sets up a perfect storm where you have institutional money getting long and retail getting scared. That combination is beautiful. I'm looking for breakouts this week. I've been pretty clear about that in my video on Sunday, and I'll continue to say so in this video. I am looking to actively add longs to my bullish positioning in the S&P 500 and the NASDAQ. Let me show you something on the indices, okay? Nick, they're neutral. Why would you get long? Fair point. Fair point. I'm not long yet. I'm looking for the trend column. You see this? I'm going to show you how the Edge Finder functions with the trend column. It's really simple. I'm going to add on to my chart here the trend saved thing that I have here, which is our A1 momentum indicator. And here's your settings. If you have the A1 momentum indicator, you can add it to your chart too if you want to keep it the same as the way I do it. 3 and 14. Why 3 and 14? Well, that's what the Edge Finder uses to calculate trend. The trend score in the Edge Finder is really basic. It looks at momentum. When this is red, basically, it's a bearish trend. When it's green, it's a bullish trend. Now, +2 scores or -2 scores happen when the direction is down, but also the slope of this orange line, right? The trend slope is negative. When both of them are going together, it gives you a +2 or -2, depending on the direction. So here, for example, let me give you, here's an example of a very bullish +2 trend score on the Edge Finder would be, we've got the film going up, right? Green film, but also slant of the line is positive. That's what I'm looking for in the S&P 500, the NASDAQ, because guys, look at this. You ready? If you get a flip from -2 to +2, let's say that we get the flip on trend. Sorry, guys. I know we have news. Let me just pull up our all markets for a second. If you get the flip, those things are going to get bullish scores. This morning we had retail sales, I believe. Is that right? Yes, it is. Retail sales came in a little bit light here. Core retail sales came in as expected. Core retail sales, but retail sales in positive territory. That's better than last time, which was negative. But forecast was missed here once more. Gold liking that. Dollar disliking? Yep, dollar dislikes that. But again, core retail sales came in line with expectations. Gold, here's your 15-minute candle. Not too much of a change. Gold ran up here this morning, pulled back pretty sharply. What's gold at today? Up 0.23%. S&P 500 is flat on the day. Sorry, guys. I know I want to finish that point that I was making because it's really, really important. Probably top of mind for me this week was I was about to get ready to tell you about how bullish I am on the indices if they break out. Anyways, minus 1.2%. They revised the previous number lower. And they revised the previous core number lower. Pretty weak. Not great. Retail sales definitely not hitting this morning. You had weakness in the month-over-month retail sales number, minus 1.2%. So they revised the previous number, which was already a miss. They revised it lower. So not great retail sales numbers, and this is not what you want to see, right? That's not what you want to see. But you can see the market doesn't seem to care too much about it. S&P 500.
Not really done too much, but the sentiment is still bearish. Definitely not looking to buy that one. So I bought the Aussie dollar to benefit from essentially just bad market on the US dollar side. We're also looking for a little bit of a correction. Obviously, a lot of the US dollar crosses have a pretty major downside since September. So we can see Aussie dollar here dropped just over 12%. So it wouldn't be a shock to me off the back of the weaker dollar that we start seeing some of these dollar crosses come back a little bit. Maybe not the full correction, but yeah, I'm starting to look to buy these ones now. Also closed out of Aussie New Zealand this morning for a nice 1.1% gain. Nothing too crazy, but you know, a little bit of profit on a Monday morning is quite nice here. So again, this one is really off the back of hold on, let me just check my notes here. So the Chinese economic data is slowing down, downside risk for the Aussie dollar. We've still got hedge funds that are long, but the markets are remaining cautious. The RBNZ, so the central bank for New Zealand, is not too bad. They're cutting rates, but I wouldn't say they're in a detrimental position. But yeah, neither of the currencies are especially bad, but we've also had iron ore that's has dropped quite heavily, affecting the Australian dollar. And obviously trade wars going on as well. We've got Danske Research in their short position is much, much larger. I think they've got to take profit down at 1.2. So they've got crazy trade. It's something huge, like down here. No, 1.2, 1.05, sorry. So yeah, I was just following their trade really and adapted it to a smaller time frame. So let me just fix that. There we go. But yeah, that's pretty much it. We've also bought the S&P as well, but that's not really done too much. I've not even marked it up yet, actually, because it wasn't my trade. We bought the S&P around here. So we're essentially going for a one-to-one trade. I don't really know. It's some complex stuff one of my analysts threw at me, so we took it. So yeah, we've got that one running on the portfolio at the moment too. Okay. How was my pizza? My pizza was delicious, although I'm on a diet now. Just did a food order, like grocery order. I got ChatGPT to write me a calorie deficit intensive food plan. I told it to ignore flavor, ignore taste, ignore cooking. So it's essentially just ingredients that I'm going to be living off for the next couple of months. It's things called like a crash diet or something. I need to lose. I've got a wedding coming up in July, and obviously the stag do coming up next month. So I need to lose a couple of pounds as soon as possible. I'm the best man, so can't afford to be coming up representing the traders as being fat. Okay. Run? Yeah, I do. Well, kind of. I need to get back into it properly, but no big deal. Sweet. Yeah, there's nothing going on really. I've got quite a wide watch list like I did last week, but there's nothing really that I'm desperate to get into. It's more just things I'm keeping an eye on. So the US dollar SEC is one I was looking to take. I don't really have a solid thesis yet, other than I think it's MUFG is currently long or looking to go long. That's about all I've got. This market, from what I've read, again, it's not something I trade. I stick to G10s really, so that's why I'm not really that excited about going in. But technically, it looks fine to essentially just continue this range trading. It would also reduce some of the dollar short exposure I've got. If we could buy the dollar against the SEC, then if the dollar does have a bullish pullback, then at least I'd benefit from that and I wouldn't go into a total drawdown. What else have we got? Euro dollar is interesting because I'm looking for a pullback here. Now, there's a couple of reasons, and it's not really a huge macro reason. It's more just the way the market's moved. It would tells me that it surely can't go up any higher. And I know that that's very dangerous words, so I'm definitely not actually shorting it just based on that. But again, as we were saying with Aussie dollar, since September, it's dropped just over 9%, and it's regained 6% of that drop in the past 2-3 weeks, which is a large rise. This is, as far as I'm aware, it's the 6th largest move in euro dollar history, and that's including things like the GFC and COVID. So it's definitely not a small move. Now, the reasoning euro dollar had such a large move is obviously off the back of US dollar weakness, but we also had tariffs. We also had the 500 billion euro fiscal stimulus by Germany. We've also got a less restrictive policy by the ECB. So it was, free game really for euro dollar bulls to make money there. But I was reading Credit Agricole's report over the weekend, and it seems most of the positive factors for euro dollar are priced in now. So the only real situation where euro dollar continues to trend higher is if we continue to get positive news. If we don't really see any developments, or if we obviously see worse developments, then it would make sense for the market to pull back. Maybe not fully correct, but some sort of pullback. It could even just be 50%, which would be to here. In that case, I'm not going to short this market by any means, so I'll be just waiting for a downside move, and then I'll be looking to go long. I think the sentiment has changed to bullish, so I'll be looking to basically jump on the bullish band or the bullish bandwagon. But yeah, it's a case of just waiting for some sort of pullback, really. Sweet. Pound New Zealand looks quite attractive as well. Yeah, I'm not sure it's quite ready to enter. It might be later today, maybe early tomorrow, if we can see some sort of rejections. There's two entry levels I'm interested in here. We've got the first one, which is actually where it is now, but I would need to see some sort of exhaustion or a bullish engulfing candle, something to confirm that this level is going to hold. So we've got the 200 moving average right here. We've got, or coming into this 50% level, we've got previous structure as well here. We've got the pound New Zealand reading bullish on the edge finder. So overall, it looks like a great long position. However, if this level doesn't get respected and it continues lower, fine, I'll look to buy it around here, which is, again, previous market structure. It would also line up quite nicely with this previous trend line. So, you know, keeping it pretty simple. But due to the sticky inflation in the UK, holding off the rate cuts, then I think that's quite a nice sign. We've had the pound actually one of the best performers in the G10 landscape. We've got UK fiscal tightening is equaling to growth risks. We've got the Bank of England easing later in 2025, but that's obviously more of a long-term outlook. Short-term, I think we could potentially pump a little or push a little bit higher, maybe even just back into this previous high. So I'm keeping an eye on it, but for now, yeah, it's not quite ready. I'm just seeing a lot of talk about pizza. I've got to say, actually, I think my favorite pizza place is Papa John's. I love the sauce that comes out, like buttery, garlicky sauce. If it wasn't for the sauce, I probably wouldn't go there, but Domino's is okay. But I think Domino's is really overpriced. We ordered 5 pizzas. I think it was, yeah, Friday. We ordered 5 pizzas. And it came to like £120. I just don't think 5 pizzas is worth £120. Like, you know, it's good pizza, but a pizza costs what, like £5, £6 to make? Crazy stuff. No wonder their stock's pretty good. They just overprice everything. Yeah, Papa John's. I think Papa John's is really underrated, actually. I never really see it get the respect it deserves. Gold, I would still love to go long on gold. I think it's just a little bit too risky right now, as we've just reached 3,000, or we reached 3,000 on Friday, and now we seem to be stuck. It's obviously 3,000 has been a huge level, you know, psychologically and in terms of targets as well. So it's probably a case now of people being a bit cautious to buy gold, but also maybe not wanting to take profits just yet. But it wouldn't surprise me if you do see some profit taken on gold, similar to what we did here, and we see it basically every time we reach a new all-time high. We'll see the market pause a little bit like we did here, then it'll have a drop off, and then it continues. So I'm just waiting, is this the pause before the drop off and then the continuation? Hopefully so, because then I can get in on one of these pullbacks or wherever it pulls back to. I think that would be pretty much perfect. But yeah, right now, kind of a no-go zone in terms of buying it. I'm definitely not going to look to short gold. You can look at pound yen. Yeah, there's not much on pound yen. I think the overall idea that I would have is go short, but with the pound strength at the moment, I'm just a little bit cautious. If we can remain either in or below this resistance, fine. But the yen seems to be giving up some ground as well.
Let's talk technicals on the bigger picture. Why do I think this week is so critical? All eyes on the Fed. Although they are not likely to do anything, what they say language-wise, comments, Powell's, press conference is going to be important to kind of lay out the groundwork for what they're looking for, expecting to do this year. Right now, the market's pricing in 3 cuts. I will take a screenshot of this right here. Let's go. Take a screenshot of the FedWatch tool for today, March 17th. March 17th at 10:25 a.m. Eastern Time. Okay, so I just want to reference this. So that way, after the Fed, we'll obviously watch what price action does. That's the most important thing to me. It's not really what Powell says, it's what the market prices. I don't know what he's going to say that's really going to, give the market a reason to rally. I don't know what he's going to say that's going to give the market a reason to fall. If they come out with like a hawkish tone, then yeah, I can see the market falling because the Fed's not being accommodative enough. We're already worried about Trump and tariffs and the current administration, basically gutting all government spending. And that's the extreme. Like, it's not actually happening. The government's still going to spend a crap ton. We're probably still going to have a fiscal deficit, but it's the optics of having Doge there that has, $1 trillion+ in mind, $1.5 trillion in mind. I've read some pretty surprising stuff over the weekend. In 2024, what I read is 34% of GDP was government spending. 34% of U.S. GDP, 34% of U.S. GDP came from government spending in 2024. That's a record. If you exclude crisis, you exclude wartime, you exclude crisis, that is a record. So we are operating from a fiscal policy standpoint as if we are in a crisis mode, recession mode, wartime mode, and we're clearly not yet, but still, unsustainable is probably the easiest word to explain it. I get what's happening as far as like why do we have the need for it. I just think that it's coming at a pretty terrible time. But that being said, I want to make a reference to this because now that fiscal policy seems to be on the decline, and we don't know how bad that's going to get and how bad this administration could potentially exacerbate those moves. But if the Fed, which is potentially going to be cutting rates this year, are they cutting rates into a recession? Maybe, and maybe it's not a Fed-caused recession, but the Fed will still be cutting when the market's still down anyway. So overall, here's my concern, and this is what I thought a lot about last week. This is how I kind of position a lot of my portfolio for the rest of the year. If this market is going to be, finding some lows and finding some resiliency, hooray. Do I think the all-time highs are possibly going to get tested this year? Maybe. I'm not sure if I shared this everyone on Friday last week, but let me go into this chart here. Okay, a couple things. Typically, if we get through the little lull of February and March, usually by March, April, the market picks itself up. We get a seasonal trend. This is called the pre-summer push. April, May, June, July, some of the biggest bull runs ever. So usually from, this is 70 plus years of trading. You get a nice seasonal trend right in here. If that is absent this year, we should all be hoping for a good Q4. But if it's absent, I don't know. This is all bets are off. This is like just going to be one of those years where you hope you don't get burned too badly. You're playing defense, and that's exactly what I'm doing. So point is, if we can get through this, which we had a nice little cleanse, the market was down 10 to 11% on the S&P, 13 to 14% on the NASDAQ, nearly double digits on the Dow. We've got the Russell down nearly 20% or right at 20%. I mean, that is in fact, I think I read this. This is the 6th fastest decline. So from peak to trough of over 10% on the S&P, that's the 6th fastest time it's ever happened. So, and again, does that mean anything? Not really. It just means that our cycles are so much more accelerated now that things move faster. But I don't think that the bottom is necessarily in. If we're going to have resiliency, what do we need to see? We would have to have inflation trending lower, Fed willing to cut. We'd have to have the consumer willing to spend, and the consumer still have jobs. Okay? If this can happen, and I'm saying the consumer as in like not the federal government worker, that cut those layoffs. I mean, I think right now Doge has I don't know if we've actually officially had the layoffs, but to what I'm reading, about 60,000+ jobs right now. It could be way worse. There could be hundreds of thousands of jobs. But for private sector, if we still have the consumer employed, we still have the consumer willing to spend and willing to kind of maintain cost of living standards. I mean, we probably need to see a housing market resiliency as well. which we're starting to see some applications picking up. But inflation trending lower, we saw that last week. Does it continue that way? We'll find out. The Fed is willing to cut and be a little bit more dovish and accommodative. Okay, fine. But I think this is going to be needed for the markets to stay resilient. Okay, if all of a sudden we see that the consumer is unwilling to spend and consumers are losing jobs, and we're starting to see initial jobless claims ticking higher, we're starting to see continued jobless claims ticking higher. If the housing market is still kind of frozen, if interest rates aren't going down too much, if the Fed is, the Fed could be willing to cut, but in the wake of a recession, the Fed is going to be cutting and the market doesn't really care. The market's going to drop regardless. So the Fed isn't necessarily going to be saving the market, in my opinion. I don't think. So a Fed put could be way lower than what the market is sitting at right now. Everyone's talking about the Fed put. Right now, it's not even a Fed put. It is a Fed put and a Trump put / administration put. If there's no backstopping this market can clearly have a pretty nasty correction. Again, I'll look at the bigger picture, but I've already looked at like a 20% area that seems pretty doable to the downside. And that's not going to be a lot of fun for anybody, but I'm just saying that wouldn't be a huge surprise to see us ultimately get there if a lot of these things are kind of this current changing of the guard. This is becoming like the new normal with a austerity-driven administration, at least for the first 6 months, 9 months. Again, I think they're on borrowed time because midterms are going to depend on what they can get done. If nobody's happy with this current administration for the first 2 years, you're going to notice it in the midterms. You're going to have this big pendulum swing from one side or the other. It's going to be all Republicans, and then it swings back to Democrats, and they lose the House and they lose the Senate. There's no more majority, and then you're right back into nothing can get done. And then Democrats maybe come in swinging, and they're trying to put things forward. You got a president that's going to veto everything. Like, it's going to be back to gridlock again. Political circus is always happening, right? But point is, if we have a correction, we have an intermediate low, that's understandable. My biggest concern is that this is a setup for more bad stuff. And this is what's scary about the markets. The reality is everything could be okay, right? But the market is always forward thinking. And if the market thinks that there's a recession, if the market thinks there's more job cuts coming, if the market thinks that consumers going to be struggling and pulling back, the market prices that in. That's the downside. Even if we would technically not be in a recession, the market could show it. 6 to 8 months forward thinking. So that level of resiliency needs to be communicated now. Because if it's not, this market's going to start pricing in things that are worse. Or this reality that's kind of lining up for 6 to 8 months from now. If we don't get better news, then the market's going to price it in. And I don't think that this little 10-11% correction is going to be the lowest. Now, historically, something like this I thought was pretty important. That it's not necessarily where you start, but it's how you finish. So we're off to our 18th worst start since 1928. And those even these crazy terrible starts. Look at this price return for the first 48 trading days. You notice some of these levels, like, yeah, they're awful, right? 2009, right out of the great financial crisis. 2020, that was during the COVID OPEX cycle from February to March. It's a horrible window. 1935, I don't even know why, right? Great Depression was 1929, but 2022 was the start of a bear market after a deleveraging that happened in late 2021. So we're off to a pretty rough start. So at least in my my career, my era, I saw that happen. I saw that happen. I saw that happen. And I saw that happen. I saw that happen. And here we are now. I'm watching it live. Even 2000, watching it live. So point is, we've had of these 17 worst starts. Of these 17 worst starts, 10 out of 17 times, the market still finished the year positive. So, and it's not an awesome stat, but it's about 58%. So is that a big enough edge to say I'm going to put all my money on the market finishing higher for the year? I mean, it's a calculated bet. But I'd say if you're at least protecting the downside, then yeah, you've got probabilities on your side. You've got time on your side. If anybody's looking, let's say 3 to 5 years out, there's really not much to worry about. If you're looking 3 to 5 years out, there's not much to worry about outside of don't lose your butt if this market's going to fall, 20, 30%. Worst case is if we fall 20, 30, 40, 50%, I mean, there's a lifetime of wealth that can be generated in that type of drawdown. But the problem is are you going to survive it?
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.